Now it's broadcast started. Okay, give me a second. There are always people who are earlier. Oh, so good. Because our practice is we start on time. We try to start on time.
Yeah.
So you don't want to miss anything, then you'll be early. So nice to see all these names here. Alex, Choi, Daniel, David, GS, Kashvina, Michael Chong, Man Ong, Shen Lim, Suresh. Okay. So maybe a warm-up question. So did anyone here already like invest in a stock in overseas? That means you bought a stock that is overseas, like foreign country, US, Singapore, wherever it is. Can you type like how many stocks are, maybe a number? If you haven't bought any, then you type zero lah. Having trouble putting it up on Facebook. Let me see. Don't know what's the issue. Sometimes can, sometimes cannot. Probably they keep changing things and stuff like that.
Well, today certainly we are going to have very interesting topic. We'll be talking about the potential US housing crisis. I think it's more or less already been determined when the Fed continue to raise interest rate like that. And the news I got this morning is that the US home prices fell 6% in 2 months, and that is the biggest historic drop over 2 months. So that means chances are it could escalate from here. If next week the Fed hikes potentially could be 100 basis point, which means a full 1%, and that would bring the 30-year mortgage rate higher than the 2006 peak mortgage rate before the housing crisis. So I'm going to share a lot of charts today, so that you all have a better idea of what's happening. And of course, we'll also talk about the EU, which is on a trajectory that I think would either break the EU asunder or will create a hyperinflationary moment in the EU.
Yeah.
So things are really not good worldwide. And
Okay. Awesome. PC. I finally got it on Facebook. Do you want to share it on your page as well? Do you want to do that right now?
Yeah, I already shared it on my page.
Okay.
I already did the sharing.
So because
so wait
of the
for
live video, you can share the live video. Oh, you did?
Oh, you mean my video is not on? It's on.
No.
Page
I
sharing
mean,
already did.
you did. The live stream. If you want to do that. I mean,
Never mind. It's okay. You
I'll give you the link. Let me see.
is
I can grab the link here.
okay. You give me the link. I post it on the Facebook.
Yep. You can check your chat box. I sent to chat box to you. Okay. So we're gonna start in a moment. Almost there. Okay. Okay. Alex said he bought a Vanguard S&P 500 ETF. Yeah, it's considered stock as well.
It's an ETF.
Yes, it's an ETF. But it's traded like a counter lah.
Yeah.
Okay, awesome. So
Hold on.
okay. Okay, it's 11 o'clock, so we don't want to keep people waiting. So thank you so much everybody for attending this webinar. So this is a special webinar where we do it publicly because PC is a trainer of one of our course we do together. It's called Invest Foreign Share, and in fact, for members, he does two webinars every month to talk about the stocks in his research and also some market updates as well. So he actually update our members every week. And today is a special, no? This webinar is public, so we let everybody to come in, and basically, if you are in my email list, you follow my Facebook page, you'll get notice about this webinar. That's how you get here. And after this, the recording will be on Facebook for a few days until we close, because we are having a new enrollment this week until 23rd of September. That's the final day that you can join the paid membership if you want to. So today you will have a taste of what we'll talk about, and see if you want to continue to learn from PC, to hear the update from PC. Then this is a very good session to get to know us. So thank you very much for attending. And today's topic, we are going to talk actually more about US housing crisis and also the Europe debt crisis. So basically 99% of the talking will be from PC. So over to you, PC.
Yeah, thank you, Casey, and thank you all who are logging in. So a bit of a disclaimer. Now, first of all, we are not financial advisors. Nothing we say here is meant to be a financial advice. Please do your own due diligence before investing. So also please do your own risk assessment, yeah? And also, if need be, please seek the opinion of a financial advisor. So today's topic will be focusing on the US housing crisis and EU debt crisis 2.0. Now, for those who are familiar with the first housing crisis in the US, was during the period of 2007 to 2008, which exploded into a global financial crisis. And of course, what followed soon after was during 2012 to 2014 was the EU debt crisis. Now, the US housing crisis started when interest rate peaked in 2006, and then subsequently we saw a lot of foreclosures because people can no longer afford the high mortgage payment. And we are seeing the same repeat of what happened in 2007 and 2008, because all the indicators are pointing us towards that direction. And EU debt crisis, of course, whatever the ECB had done during the last 10 years have only brought about more debt, as well as both the ECB and Fed actually have caused high inflation, although it takes many years for it to play out. And we are going to explore all this right now. So key points of today's presentation, we'll talk about the US housing crisis first, where we look at the US housing sector. Then we have a look at the US household, how inflation and the Fed's interest rate hikes will undermine the household, then how this will create another housing crisis. Then we move on to the EU. We'll talk about the energy crisis, inflation and debt, and the destruction of the EU's industries, how civil unrest will upend the political system, and then the EU's GSIBs, why are they vulnerable, and why the ECB would be impotent to act. So how the breakup of the EU could happen. Now, for most of us who invest in foreign markets, we often follow what the ECB and what the Federal Reserve say. And so far, most of it has been a lot of talk. Okay, they try to use narrative to point the market towards the direction that they want the market to head to, but narratives no longer seem to be working. And for those who really trust what the Federal Reserve say all through the years, I think it's best revisiting how honest are they, because just before the blow up of the housing crisis in 2007 and 2008, Ben Bernanke says that the housing crisis is contained. And then subsequently, Janet Yellen, before she left, the Federal Reserve Board. She said that she will never see a recession or a crisis in her lifetime. And subsequently, we have Jerome Powell, when inflation was already running high in 2021, he said that it's all transitory, okay? And then, of course, we have Mario Draghi, who said that whatever it takes. So whatever it takes right now is leading the EU into a inflationary cycle. So let's talk about the US housing sector. Now, these are the key US housing indicators, and we'll probably will know more in the coming days next week, because US would print their new indicators for the month of August. Now, these are actually up to the month of July. Now, if you look at it, okay, US pending home sales, this is during the bottom of the financial crisis, and you can see that we are approaching towards that level. And then US existing home sales, this is when the US housing crisis hit, and then it is moving down towards that as well. And then US new home sales again has been falling, and then US housing starts, which is actually a laggard, but I think it will continue to fall as the 30-year mortgage begins to rise. So, but this is comparing the year of 2005 and 2021, because 2022 has not ended, and this is done by Eric Basmajian from the EPB Macro Research. So what he did was he compared, okay, the price of homes before the housing crisis in 2005, which is here, and then the current housing price growth in the US in the year 2021. So what he says that during 2025, most of the rise in the in the price of real estate was actually over here, and then in Florida, and then some parts on the East Coast here. But what he found was that throughout the US in 2021, there has been increase in the price of homes. So that's why, it's more general across the whole nation in 2021 versus 2005, where it is within certain areas along the west and on the east. So that could only mean that, more people are paying much higher home prices throughout the country rather than over several states in 2005. And that what makes the situation even more precarious if, let's say, there's a housing crisis. And from what we can tell, the first few months of 2022, we have seen home prices continue to increase. So this is another chart by Eric, and he shows that months of supply of US single-family homes. Now, this is when the home supplies continue to move up, it means one thing, that people have less intention to buy homes, or that the home have actually increased in price so much that it has been priced beyond the affordability of the average family. So what is important to distinguish here is that existing single-family homes will spike when more people rush to sell their homes, when the cost of sustaining a home becomes overbearing due to rising mortgage costs and high inflation, especially in energy and food. And food inflation is really going to hit us hard across the world because of falling production in major agricultural-based countries, and also because of the banning of Russian and Belarus fertilizer, which actually are needed to sustain the growth of the production of the staple crops and such. So the other thing is that new single-family homes will continue to spike when more consumers find it difficult to afford owning one. Now, this is made worse by rising mortgage. So all these factors will continue to interplay to create an environment where the chances for a housing crisis, becomes more elevated. So here's a look at the 30-year mortgage rate and the median sales price of houses sold, okay, for the US. Now this is the red line where the median house prices are. Okay, now just before the fall in the in the price of homes during 2007 and 2008, the 30-year mortgage rate peaked at 6.21%. Now the current rate, now this was just a few days ago, was 5.66, but the news I got this morning is that it actually has hit about 6.02. So the next interest rate hike of 0.75% will likely push the 30-year mortgage rate above 6%. And since it's already at 6.02, I think this morning, chances are it would actually hit higher than what happened in 2006. So another thing we need to compare is that after reaching a bottom in January 2021 at 2.65%, mortgage rate has climbed 113.6%, and it will likely to rise even higher where the rate of climb is concerned once we build in the 0.75% hike. Now, at the same time, the median sales price of houses sold has increased 71.1% compared to the peak achieved in 2006, which is here, just prior to the housing crisis in 2007. So right now, the most important thing that we need to discern from the chart is that the price of homes have actually increased much higher than previously. And right now, the mortgage rate will likely increase much higher than what we experienced in 2006. So that is why the mortgage payment would actually be rather exponential. So this is the monthly mortgage payment based on the median existing home price, okay? And we can see that this was what the household actually paid. And between here and here, it has actually increased more than 50%. Okay, then the peak of monthly mortgage payment prior to the housing crisis in 2007. And if, let's say, interest rate continue to hike, then this will push even higher. So the housing crisis in 2007 soon erupted in a global financial crisis in 2008. So if, let's say, we have another housing crisis right now, what are the chances of another global financial crisis? And I would say it's rather high, because just before the housing crisis, the amount of debt in the US is very small compared to the present. When we look at the Fed's balance sheet, it has actually increased almost 10 times. So that means that from about 800 billion prior to the housing crisis, right now the Fed balance sheet, the total assets have gone up to more than 8 trillion, almost 9 trillion. So it's actually more than 10 times growth. Why has the Fed's total assets been increased? That's because through QE, where the Fed keep on buying the assets to pump money into the market. So that's why credit has expanded dramatically. And of course, the Fed kept on saying that there's no inflation throughout the last few years, because the inflation has gone into the property market, has gone into the stock market, has gone into the bond market. So right now, we are seeing inflation, coming into the commodities market, inflation coming into the wages of people, because as inflation spikes higher, people demand higher pay. But because inflation is rising faster than the rate of growth in wages, we are seeing a deterioration in real wages. So let's look at the household debt. Now, total household debt in Q2 2022 reached 16.15 trillion. of which mortgage balances, the largest component of the household debt, stood at 11.7 trillion. Non-housing debt, which is consumer debt, auto loan, credit card, student loans, stood at 4.54 trillion. Total household debt as a percentage of GDP stood at 65.1%. Now, if we look back during the just before the financial crisis over here, okay, somewhere around here, you can see that the household debt, when it comes to mortgage, has been higher than 2008. And then the consumer debt, okay, the non-housing debt has been higher than previously. So right now, all sorts of debt from the household have risen much higher than what happened during the financial crisis. Now, if we look at the personal savings and consumer loans, you can see that the blue line here, okay, personal savings have actually deteriorated, just as consumer loans continue to climb much higher than during the just before the COVID. Okay, so consumer loans is now at a new record high, while personal savings rate has plunged to its lowest since 2009 October. Now, this goes to show that inflation is playing havoc on consumers' livelihood. It is forcing them into debt and at the same time depleting their savings. So this is what inflation does. When we have energy inflation, we have food inflation, then we have mortgage payment, which has increased. So all this would actually mess up the consumer livelihood, because they then have to decide against three important priorities. So higher interest rate will just impoverish the consumers, as they have to decide between servicing the debt or putting the food on the table. So it puts them in a dilemma, because without energy, okay, then there's a lot of things that they cannot do, okay, even though they have their own home. If let's say, and another report which I did not include here, it shows that 1 in 6 Americans are actually behind in their electricity bill. So that's what inflation does. You can just imagine that a household running a clay pot chicken rice store, they have 20 pots, but they only have 10 covers. So how do they manage to cover, all the pots at the same time? So they have to prioritize. So what happened is that it's the same thing with the consumer. When they can pay the mortgage, because of the escalating mortgage payment, they have to sacrifice, perhaps eating less. And if let's say they eat less, but then there's also energy cost, how would they continue their livelihood? So what happened then is that the only way they can continue or sustain their livelihood would be then to borrow more. Okay, and that is why we are seeing a spike in consumer loan, and that will be very deteriorating to the consumer when interest rate keeps on escalating upwards. So this is another chart showing the weekly wages earnings and consumer price index. Now you can see that real earnings have fallen 8.9% since reaching a peak in Q2 2020, which is here. And at the same time, CPI has increased 9.3%. So inflation is accelerating, whereas real earnings is decelerating. Consumers have to cut their consumption or rely on credit to sustain their livelihood. Consumers are also facing another crisis due to mounting interest payment on debt. So they are facing a lot of stress right now, and that could only be at the deterioration of the US economy. Now, you must know by now that the US economy is dependent on about 65 to 70% on consumption. Okay, if let's say consumers have more money to spend and they have maxed out their ability to maintain a loan, what will happen to the GDP? So right now, even though, sometimes we see the retail sales, which the report which came out yesterday. So retail sales are seeing some increase month on month. But what is important is what is the real retail sales, which is less inflation, after you less inflation. So for all we know, net retail sales could be a very borderline cases, hovering maybe just slightly above zero or negative because of the high inflation rate. Because inflation, when measured in value of money, whether you buy, as long as, even if consumption drops slightly, but it will still reflect as higher consumption if we based on a monetary sense. But if we net it off against inflation, it could be in negative. So that is why the US has had 2 quarters, in negative growth, because once we price in inflation. But then again, the CPI in the US is actually a lot of BS, okay? Because over the years, they have changed the metrics. Now, if you want to have a clear picture of how much inflation the US is facing, please visit shadowstat.com. And it will tell you, using the same metrics that was used in 1980 to measure the CPI, inflation is actually closer to 17 or 18%. Because all through the years, the Fed has actually shifted the goalpost from the, let's say, in terms of home prices. Previously, they used home prices to gauge inflation. Right now, they use something called owner's expectation of rent. And that rent inflation is single digit. I think it's about 5 or 6%. And even that, is not reflective of the true picture. Because if you go to another website that shows you the median increase in the price, in the rent over US major cities, is actually double digit. Now, why does the Fed wants to underplay the shelter or rent inflation? Because it constitutes more than 35% of the weightage in its core inflation. If let's say the core inflation is brought down, that means it will boost up the real GDP. And if let's say they allow it to run rampant or even follow to the average rent increase, which is in double digit, then the GDP would be deeper into negative. So that's why, it is being manipulated such to an extent. Now, the other thing which the Fed never considers is that inflation has brought about in the type of goods that are produced shrinkflation, which means the price never changed, but then the quantity have changed. Everything has shrunk in terms of packaging size, but prices remain. So that was, shrinkflation has never been taken into consideration into calculating the CPI. So that is why a lot of the picture of the true economy is being smoke and mirrors right now, because every government is looking at saving their own skin in trying to downplay a lot of the negative sentiment. So how inflation and interest rate affect the household? Now you can see that household net worth was boosted by the COVID stimulus, where they print free money and give to the household. Now, post-stimulus, inflation begins to eat into the household net worth, and inflation is actually a tax on the household. So you can see that the blue line here is the household. So it reached a peak, and then subsequently, post-COVID stimulus, it started to decline. Okay, meanwhile, consumer price index have gone up. Now, during this period, even when consumer price index was going up, they are still being subsidized by the government. And therefore, the net worth did not show any impact until it reached a peak where the stimulus have ended. And then right now it's trending down. Now, if let's say, like I mentioned just now, earlier, within the last 2 months, US home prices have collapsed on the biggest scale on record, which is in 2 months, it collapsed 6%. So if let's say the trend continues, then this will fall pretty badly on the downside. Now, you can imagine that just now we say that house prices have increased 71% since 2006. So if let's say it start falling, then we will likely see a continual trend towards reaching a point where we will have the similar crisis as last time, because right now consumer debt has skyrocketed, household debt has skyrocketed, and any increase in the debt service will actually create more stress on the consumer. So if we look at the household net worth, okay, and the federal funds rate, which is actually the interest rate. So we can see that massive monetary easing by the Fed post-2000, 2008, and 2020 have resulted in household net worth accelerating, only to see declines when interest rate peak. So here was the dot-com bubble burst in 2000, and then subsequently, Greenspan started easing. Then when it reached a bottom here, you can see that the household net worth began to accelerate, and then it started to increase interest rate. While he began to increase interest rate, household was actually still increasing, because there's always a laggard when it comes to interest rate. Just like the Fed have been zero range bound in its interest rate for so long, but we can see the effect of the inflation like 12 months down the road. And similarly, any interest rate hike, we will only see the effect on a much later time scale. So this was what happened, okay? Reached 5.26%, the federal Fed fund rate, then it started to decline, okay? And then monetary easing again. Now this period of monetary easing, you can see that it is for so long a period that the stock market started to accelerate, and because the household invests in stock market and property, they see exponential growth in their net worth. And then we have COVID, but the interest rate hike was only before COVID, up to 2.5% before we see it began to fall, and then followed by the COVID, and it dropped. But then the interest rate hike was not sufficient to cause a deeper downtrend in household net worth like what it did in 2007 and 2008. But right now, inflation, if they decide to add 100 basis points, will actually be much higher than what happened when the Fed raised it to 2.5% during this period. Okay. Now, if let's say the Fed raised much higher than here, the next housing crisis will actually cause the net worth to fall even deeper. So, in a summary, higher the interest rate, steeper the decline. Comparing 2008 and 2020, household net worth is set for steeper decline if the Fed hikes further. So this goes to show that can the Fed really continue to hike much higher without causing a lot of crisis in the international monetary scene? Now, this was when the Fed hiked to Fed funds rate was around 2.25 to 2.5%. We already see just before 2020, we have the stock market crash in 2018 from September to December. Then we have the repo crisis also during the period of September 2019. And then subsequently, the Fed stopped its QT. And then in 2019, it started to put a stop on raising interest rate. So that goes to show what raising interest rate can do to the economy when every sector of the economy is very heavily indebted. Now, How will this interact to cause a decline in household net worth? Now, household net worth is total assets, value of assets, financial as well as non-financial, minus the total value of outstanding liabilities of the household. Inflation will lead to higher interest rate hike, okay, would lead to higher interest payment and decline in household net worth. So how do all these affect the household? Now, average household rely on debt to invest in securities, be it margin loan and personal loan. Now, just before the fall in the stock market early of this year, total margin loans in the US stock market reached almost 1 trillion. Actually, it's 900 over billion. Okay. And buying or investing in properties, which is the mortgage loan, to grow their net worth. So it's either securities or properties. Inflation results in the deterioration of the value of securities, bonds, and stocks as the cost of doing business for corporate increases. So that's why higher the inflation means lesser profit, and therefore the stocks value would also drop. That's how inflation impact the companies, and then subsequently impact the investment of the household on these companies. Now, inflation also would cause the Fed to hike interest rate. Okay, but one thing we need to note is that when the value of stocks deteriorates, margin calls will kick in, forcing liquidation of stocks in the portfolio, which then creates a cascading event, which means it's going to plunge even deeper as margin calls at multiple levels is being triggered, because everyone is so afraid that the Fed will hike interest rate, and therefore it will increase the cost of doing businesses for the corporations. Okay, earlier we said that inflation affects the performance in terms of rising cost of operations, but higher interest rate will also increase the cost of doing business among corporations, because a lot of the expansion and activities carried out by the corporations are through debt issue as well. So therefore, higher interest rate results in higher mortgage payments and higher debt service payments for loan. And this actually affects both the household as well as the corporations. So failure to service mortgage loan, especially for the household, will result in foreclosure, and household could be forced into bankruptcy and homelessness. So this is how it all are being slowly being how I would say, it's a cause and effect kind of thing. So when the consumers have all been tapped out, the household have been tapped out of any access to credit, the only leeway then would be to declare bankruptcy. But if, let's say, the moment the value of the house drop, but then they are still saddled by mortgage payments, so what will the household do? They will actually head towards the exit, and therefore they might even have to sell at the loss to cover their kind of loans. So that is why, if they do not want to sell, they still want to stay, they will be forced into foreclosure, and they will be kicked out of the home, and therefore they become homeless. So this is how it's all going to be happening in the coming months. So how a housing crisis is created? So we can see here that the real M2, which is broad money supply, when credit tightens, it pulls liquidity out from the market, and it affects all types of assets classes, including real estate, stocks, and bonds. Bank will be less willing to lend, and borrowing costs will soar. Now, this is how the broad money growth is happening. It has fallen to negative 5.6%, whereas during the housing crisis, it was still at 4.8%. So that goes to show that the current credit situation is much worse than before than during the housing crisis. So there's no escape from this in some sense, because there's no credit in the market, and therefore borrowing cost is set to soar. So what we have right now is that the Fed is talking a lot about monetary tightening. Now we look at the interest rate aspect. increase in mortgage payment and other debt service payment because of the hike in interest rate. Housing becomes more expensive, pricing it beyond the affordability of ordinary household. There'll be less takers, okay? And that's why just now, as I mentioned, housing inventory is going to shoot up. So inflation is forcing households to prioritize their spending to meet their basic necessities, such as food and utilities, leaving little to cover their mortgage payments, could result in foreclosure. Then we look at quantity tightening. Now, reduction in US treasuries and mortgage-backed securities held by the Fed, which means the Fed will actually be selling all this into the market or allowing them to expire without reinvesting. So it will increase the supply of MBS in the market, which will crimp demand. So low demand leads to higher yields, and this will force the mortgage rate higher. Without the Fed acting as a major buyer of US Treasuries yield will spike, adding to the fear of more interest rate hikes in the horizon. So these are all a vicious cycle that is, of one thing leading to another. So that's how the US housing crisis will play out. And let's look at the EU by first looking at its inflation, energy crisis, and debt. Now, the EU inflation right now is at a new record high at 9.1%. The US dollar to EU have reached parity, okay? And then right now it's slightly above parity. And we look at the Ecb total assets. Now, the Ecb is just like the Fed. They print money by buying back all the government bonds, allowing the European Union governments to keep on funding themselves. So it is the ECB massive QE or monetary expansion during the COVID pandemic, and to finance troubled economies within the bloc that resulted in inflation getting out of control. Inflation reduces the purchasing power of the currency. Therefore, it is not surprising to see the euro falling steeply against the US dollar. Now, a lot of people are saying that the US dollar right now is very strong. Now, the US dollar is a reflective of the US dollar index, the DXY. If the DXY remains strong, the dollar would be strong. And the problem is the DXY, majority of the DXY comprises of a measurement of the US dollar against other dominating currencies such as the euro and yen. So when the euro and yen has fallen so steeply, of course the US dollar would look to be the cleanest shirt on the dumpster. So that is why it is very it's just on a relative basis and comparatively basis. But if we want to say which have been the strongest performing currency, and that is the ruble this year, because it has fallen from its peaks of 150 ruble to the US dollar right now to about slightly above 60. Okay, and that is the strongest performing currency. So inflation actually takes away the purchasing power. And how can we say that the US dollar is strong? That ever since the 1971 removal of the US dollar backing by gold in 1971, US dollar purchasing power have actually fallen more than 90%. Okay, this is just some food for thought. So the US energy prices keep climbing in the EU. Now, these are all double digits growth on the monthly basis, yeah. So that's why if we look at Germany electricity price, it has gained 170% year on year. France have gained 414% year on year. And Italy electricity price have gained 205% year on year. So that's how much it is costing the governments. Now, so what the EU government wanted to do. Now, the EU wanted to cap the price of oil from Russia and signal its intention to intervene in the electricity markets. Now, we all know that any government intervention in the free market economy, and that includes electricity markets, will have wide ramifications. okay? Because when you are putting a fix on the cost of electricity to the consumer, you are not putting a fix to the cost of the raw materials that are needed to generate that electricity, because inflation is always pushing the cost of raw materials higher. So what will the company do then? They will be deeper into trouble, and I will explain it afterwards. Now, Russia responded that it will just stop supplying its oil and gas to the EU. Okay, if let's say it wanted to, put a cap on Russian oil. Okay, capping the price of oil will likely draw the ire from the OPEC, and I believe more cuts will be announced if the global economy slows down. Now, the OPEC already says this. Previously, there's high demand, oil price was rising, and the OPEC countries are pretty happy about it. But they have already sounded, if let's say there's a global slowdown, there is really no reason for us to keep on injecting oil into the market. So it will not, the capping of the price of oil will not get the support of the OPEC. And the OPEC right now, especially Saudi Arabia, they are actually importing Russian oil for their own consumption, whereas the oil that they produce is being sold to the Western nations. And they are, they have very, very good premium, because Russia is selling oil to the Saudi at a discount, not at market price. So they get added revenue when it's sold to the West. Now, according to JP Morgan, now this will happen when Russia cuts its own production in response to the EU's threat. Remove 3 billion barrels of oil per day, oil will spike to $190 per barrel. Remove 5 million barrels of oil per day, oil will spike to $380 per barrel. Now, this is regardless of the economy situation. So many analysts warn that any price capping will be doomed to failure. EU governments are also announcing plans to subsidize their citizens and companies' electricity costs, which has spiraled out of control, plunging many governments deeper into debt. Now, if we look at the EU debt, at the end of Q1 2022, the government debt to GDP ratio in the euro area stood at 95.6%. Most indebted countries within the bloc, we are calculating the public debt or government debt to GDP ratio and how their 10-year bond yields have risen as at 13 September. Now, Greece debt to GDP is 236.5%. Increase in yield is 341 basis points year on year, which in terms of percentage is an increase of 430% year on year. Italy debt to GDP is 176%. Year on year basis point rise is 324. Percentage change is 461. Portugal debt to GDP is 147%. Year on year BP rise is 247. Year on year increase by the rise in the basis point is 1,061%. France debt to GDP is 130%. Year on year increase is 222 BP. But increase is 8,465% year on year. Now, why is it France increase is so high? Number one, because when the ECB was easing, France interest rate was very close to 0%. And therefore, when the ECB hiked it to 2%, where the yield is, when the ECB hiked interest rate at 75 basis point, the 10-year yield actually spiked alongside it. So that's why France see a much wider scale. But then if you look at Belgium, debt to GDP is 120%, year on year is 231, but then it's 57,000 increase because the 10-year yield have to be a bit more general, okay, across all the countries within the EU. It's just that some of them have very, very low at some point in time because of their better finances. But then when the yield spike, okay, it caused a much wider increase in terms of percentage. Now, Spain is 111% debt to GDP. BP rise is 447, equivalent to 724%. Now, why is it that the great, the countries of southern peripheral countries, which sparked the Euro financial crisis in 2012, they don't see a higher percentage change? Because their yield has already risen from the lows last year, because people are already knowing that these countries are actually not doing well economically, and therefore the 10-year yield have actually risen prior to the ECB hiking their interest rate. And that's why the impact of the rise year-on-year change is not so much. But for those countries like Belgium and France, their 10-year yield wasn't so high, but then a subsequent hike have resulted in a lot of 10-year yields rising across the board, and therefore we see a much higher percentage in terms of increase year-on-year. Now, with the ECB expressing that it will continue to raise interest rate to battle inflation, many of these countries will see increased burden in servicing their debt. If you want to check in the future, you can actually refer to US Debt Clock and governmentbonds.com. This is where I got my data from. Now, destruction of EU's industries affect all industries from the manufacturing sector and the service sector. The sector with the highest risk is the utility sector, which many utility companies now pleading to their respective governments to bail them out. Their combined margin cost was reported to be in the region of 1.5 trillion. That's just the utilities, So because most of them have hedged for certain percentage of increase, but when the price of gas have risen by triple digit, there's no way that they can actually cover their hedging, and that's why margin costs are being called across the board in many, where a lot of all these utilities companies are concerned. Now, several governments have announced their intent to bail out the affected companies. Such as Germany and France. Now, the other thing is that many smelters have announced the shuttering of their operations as energy costs makes it unsustainable. Now, if you are operating as a smelter, the amount of energy consumption is tremendous. And at this kind of cost, there can be no way which these companies can actually be able to recover from. So this will lead to a shortage of metals in the market and could push the price of metals higher going forward. Now, if you visit the LME, the London's metal market, you can see that their inventories of metals have actually been falling down drastically. So what happens when the LME runs out of metal? Because no matter what, there'll be demand for metals for certain industries' production, which doesn't require as much energy. Okay, let's say the automobile sector. Okay, so the other thing is that small business owners are also facing difficulties, with many having announced their intention to close their outlets. Who will bail out these owners? Now, there was a report that some pub owners, okay, are seeing their electricity price increase, okay, by manifold in just a few months. So what happens then when factories cannot sustain their operations? We are not talking about the smelters. We are talking about other types of industries, okay, that require input from the smelters. So assuming right now the smelters have stopped operating, price of raw materials has skyrocketed. So these factories that rely on the smelters for their supply of raw materials, what have happened to them? They now not only have increase in electricity or energy costs, they right now have runaway increase in the price of raw materials. So can they sustain? So what happens then when businesses fail to meet their financial commitments? Now, by right, a lot of economists have already mentioned over the years that a lot of the companies in EU and the US, are basically zombie companies, which means they do not have any revenue or net profit yet, but they are being bought up because of the hype, of the technology or improvement in the processes. So, how they manage to garner the investor support by always putting up something that, previous years we haven't seen, but in recent years we see a lot. They keep on hyping the TAM, total addressable market. It's something which the total addressable market is few hundred billion. Right now we are just starting stage. So you see a lot of investors jumping in, pushing up the investment, the share price of these companies, but they actually have no revenue or net profit to show. But in order to keep on sustaining, they need to borrow from the debt market, to fund their expansion. So what happened when these companies, see escalating costs? And that is why the IT sector and technology sector has seen the biggest layoff of employees, because a lot of them have not enough revenue to sustain the amount of money that they have borrowed from the debt market to fund their expansion. So it is inevitable that the EU could see rapid deindustrialization, massive layoffs, rising bankruptcies leading to riots and demonstrations among the populace. And all this will put the EU's economy and currency at risk, and perhaps put the entire EU banking system on a path to a collapse. So government which require deficit spending to fund their budget will find it increasingly painful to do so. Unless there is a remedy, some countries could face default on their debt. For businesses which are already struggling with very high energy costs, they now have to contend with higher financing costs. Those who have borrowed on the cheap a year ago must now pay exorbitantly to refinance their debt. Not only that, the global economy is slowing down, and the EU is expected to see a severe recession. Hiking into a severe recession could result in a depression. Now, this could put many companies and businesses and business owners on the path to bankruptcy. So you can see that, it's one thing leading to another, and there's no way that the EU can get out of it. Of course, there are some painful choices, continue to hike interest rate to fight inflation, but result in a depression across the EU, or they want to bail out everyone because of the high energy costs and then have hyperinflation in the process. Now, these are only two ways out. So civil unrest and political challenges. Already, we are seeing all this happening and revealing before our eyes. So we have the mass protest in Prague, okay? And then we have the farmers' protest in Germany, farmers' protest in Netherlands. Now, a lot of the protests in the Netherlands and in Germany were triggered by, and in Czech were triggered by the high energy costs and ESG policies by the EU. Now, the ESG policies by the EU is actually something that is good to have, but it's really very difficult to achieve. Can you imagine that they are asking the farmers to reduce their cattle herd because they say that the fat from the cows can lead to climate change because they release methane. So that's why the farmers are protesting. And then they are telling some of the farmers to use less fertilizer because it's not good for the environment. So all this ESG thing, is like a woke economy, and it is actually to the deterioration, because there is no way that you can have all these ideals being implemented when around the world, only 5% of total energy generated is from renewables. We are still majority using fossil fuel. Now, of course, it's very easy to say we are running on full electrification of the infrastructure. Anyone wonders where the lithium, the copper are coming from? Now, lithium is being mined in some of the driest places on Earth, and they require lots of water. Rare earth minerals that are required for the magnets that allow the windmills, okay, to generate power. Where are they from? Rare earth mining is actually one of the most carries the most highest environmental damage. So then we also have the windmills themselves. Do you know that the windmills blade for the wind power are never recycled? They are buried in the ground. So a lot of all this is actually, you know, when we want to look at it, how much clean energy is there then? Because if, let's say, it's so destructive of the environment, how could it be ESG compliant? But it can be ESG compliant because it's not being done, it's being done outside the EU. Okay, and you know, that's how it is, you know. So that's why the world is not ready for all this, you know, until such time where they have better processes, more efficient allocation of resources. Otherwise, we will continue to see the ESG providing an external pressure to the price of raw materials, because there's a lot of compliance issue. And as long as there are a lot of compliance issue, the higher the cost of extraction of these minerals and raw materials will happen. So the other thing is the political upheaval. The far-right movement is making their voices heard. The liberal parties are being challenged. And recently, I think the right movement in Sweden have won over the Liberal Party. Okay. To make matters worse, the dominating liberal governments in EU are facing challenges like economic slowdown, energy crisis, and a very frustrated public. Now, this month, Italy will have its general elections, and the EU skeptic party, the Five-Star Party, could win the elections. Their win could trigger more problems for the EU. The EU ESG policies too is fanning wide criticism, as it could destroy the EU's agricultural industry, resulting in massive protests among farmers within the EU. As a result, the EU is not only facing an energy crisis, but potentially a food crisis. Civil unrest protests are about to get worse as the EU enters into the winter months. Now, this could swing support for the far-right movement, which could upend the EU political system eventually. So it's already happening, you know, at this moment, just as I'm talking. You know, there are widespread skepticism right now across the EU because, you know, of the rising costs. So why are EU's GSIBs vulnerable? Now, some of you might not have prior knowledge, but GSIBs actually stand for globally systematically important banks. Well-known economist Alasdair MacLeod has frequently talked about the risk of a financial collapse in the EU banking system due to the high leverage prevailing among the EU G6s. Now, this is Societe Generale, okay? Their gearing ratio here is the total debt over total equity is 22.5 times. Deutsche Bank is 20. Credit Agricole is 27. UniCredit is 14.8. BNP Paribas is 22, Santander is 16.4, ING is 17.6. So price to book is the measure of share price over the book value per share or net asset value per share, and market cap to balance sheet measures the market cap to total assets. Now, this is how he derived the calculation. But let's look at what's happening that's more important. Now, because the major components of a bank's total assets comprise of financial assets, which are securities and loans, a slowing economy will have negative impact on the value of its financial assets and the quality of its loans. When the company's business owners and individuals file for bankruptcy and the market crashes, there could be a point when the total liabilities will far exceed the total assets, leading to negative equity situation. Now, this will collapse a bank and cause a bank run unless the government steps in to bail it out. Now, it has happened a lot throughout, most recently during the global financial crisis, where every central bank, in most of the developed nations, step up their bailout of all the major banks, because otherwise we would have a chain reaction. And that's how the G6s, okay, can influence the global financial situation. And Alistair MacLeod points out how banks themselves, okay, could tighten credit and expose themselves to risk. Very interestingly, okay. Now, the price of, according to Alistair, the price of book values, all these banks are at a discount, some deep enough to call their immediate survival into question. As you can see here, the price to book is really, really very low. Okay, so they will need, okay, to protect their shareholders' equity. And these banks have no alternative but to contract their balance sheet where they can. So when this occurs, a downturn in GDP is due in large measure to the withdrawal of bank credit. So because their assets are actually including the loans, so what they do is they want to reduce their exposure of risk in their loans. So they will actually not continue to borrow, continue to lend money to borrowers. So they will actually increase interest rate. Okay, some of them might be calling the people who took their loans, you know, offering discounts to quickly clear the loan, okay, to reduce their exposure. So when you pull credit from the market, okay, it will result in a downturn of GDP, because according to Alistair, GDP in a large sense measure the a downturn in GDP in a large measure, okay, relates to the withdrawal of bank credit. Now, this is bound to expose and create bad debts, which threatens to wipe out shareholders' capital entirely. So how, if they pull into, if they call in their loans, then people would realize that the bank is in trouble. So then there'll be bank runs. So when this happens, okay, certain people would, you know, would actually not want to back the bank, especially investors, those who hold the bonds, they want to bail out. So that is why, you know, even by tightening credit itself, it will expose the banks to additional risk. So this is how GSIBs can actually, situation for GSIBs can actually turn very nasty. Now, GSIBs invest in government bonds. Now, due to overwhelming debt to GDP ratio, governments could default, resulting in bonds which the GSIBs have invested in collapse in price, damaging their balance sheet. As mentioned earlier, deterioration of the quality of loans held in the GSIBs portfolio could also damage their balance sheets. GSIBs also own other GSIBs bonds, which the latter issue to fund their operations and expansion. So a collapse of a GSIB could transfer the risk to another and so forth. So eventually, we will have cascading of risk across the entire banking system. And this is how it is, okay? Now, how the interconnectivity of the GSIBs could shake the core of global financial system in the event of a banking crisis in Europe. It won't stay in the Europe because some of the Japanese bank here, like Sumitomo and Mitsubishi, I believe these two are the banks, okay, also carry a very high leverage. Now, trouble in the GSIBs could spill over to the OSIIs, which are other systematically important institutions. Now, these are like the insurance. Remember how the global financial crisis unraveled and then it hit AIG, which is not a bank, but it's a financial institution. Now, that was how the global financial crisis was triggered. So you can see here, okay, how they interrelate with each other, and the failure of one can actually cause a failure of two or three, and then it will spill over. So why the ECB is important to act? The EU is mired in an inflationary spiral. According to the IMF playbook, nations fighting an inflationary spiral needs to have an interest rate of 1% above the inflation rate. Now you can see how double standard the Western banks are. When they are loaning money to third world countries or developing countries, they insist that if you want to fight inflation, you must have 1%. Well, right now the EU is at 9.1%. The US is at 8.26%. How come they are not raising their interest rate to 10% and 9% respectively? Because it's now not on their front yard or their backyard, but inside their own household. So that's why, it's a double standard. We apply different standards. And also the other thing is that they are too deeply in debt. So it's okay when other countries are too deeply in debt and then they can impose standards. But, when it comes to our own debt, it's not okay for us to impose the same standard. So with the EU having an inflation rate of 9.1%, that will require the ECB to raise rate to 10.1%, assuming that the inflation won't get worse, which it will. At 10.1% interest, it will force many heavily indebted nations into a sovereign debt crisis, a repeat of what happened in 2012. ECB would then have to expand QE to absorb the debt that nobody wants. On top of that, with deep recession being widely anticipated in the EU in the coming quarters, the ECB would be even less reluctant to hike aggressively. Meanwhile, the EU has to contend with widening public distrust and angst against the fall in real earnings, high energy and food costs, and an overall deterioration in living standards. The EU would not allow the ECB to act independently. That's why the ECB will not achieve its objective in combating inflation, and what happens then would be a hyperinflationary spiral. Should the ECB hike aggressively, it risks hiking into a depression, which won't end well for the EU and the governments of the nations within the bloc. Now, this is the same story for the Fed, okay? Because US total debt right now is about 125 to 130%. And the other thing with the US is that they have tremendous amount of unfunded liabilities. Now, these are the liabilities in their Medicare as well as in their Social Security, which means the Social Security is like, having little or no money at all. Whenever they need to pay out from the Social Security, the US need to borrow from the debt market. Now, if we include the unfunded liabilities in the US, which is closer to 160%, which is closer to, I think a few 100% of the GDP, okay? It's about 160 trillion, where the unfunded liabilities is. US is about 21, 22 trillion economy, okay, about 8 times. Total US unfunded liabilities plus total US debt, which include corporate debt, household debt, consumer debt, all those public debt, all add in. For the US, total debt plus unfunded liabilities is closer to 1,100% of the GDP. So that's why no matter what the Fed says, what is important is what does the Fed do? So of course they can continue to hike, but to what extent when the US government cannot afford such a high interest of payment on its debt? Now, another thing is that the US government has shifted from owning long-term debt called the treasuries to now what we call the short-term debt called the T-bills. So which means if interest rate keep on escalating, the T-bills yield will actually keep on escalating as well. So that means the borrowing cost would be much higher. So at what point will the Fed say, we can't do it anymore? Because that would call into the solvency of the US government into question. Can you imagine if, let's say, it's 9% of just the government debt of about, let's say, 30 trillion. Okay, 9% is 2.7 trillion, more than 50% of its total tax revenue. It can never happen. So that's why all the central banks are trying to address the inflation, trying to address the slowdown by saying that, what we are seeing in the recession right now is transitory. Previously, inflation is transitory. So then they try to say that we are in control, whereas the fundamentals are showing that they cannot be in control because of the underlying fundamentals. So how the breakup of the EU could happen? Now, the Russian-Ukraine war and the global ESG policies have shown to the populace that the EU is agenda-driven, specifically the agenda of the World Economic Forum. Now, the ESG actually stems from what the WEF have said over the last few years, because they believe in an utopia, okay? Now, the EU does not have the interest of the communities at heart. If let's say they have, they wouldn't have encouraged Ukraine, to keep on waging a war that is causing a humanitarian disaster in terms of lives lost, but actually to negotiate, for a peace settlement. When distrust, angst, frustration, and anger collide, it will force the communities to react. When communities react, it will force governments to react, failure of which a new government will be formed. In the process, there could be widespread protests, civil disobedience, demonstration, and even riots, causing widespread chaos within the EU. The far-right movement is gaining an audience and acceptance among the communities and will push its agenda for governments to be independent of the EU in deciding what is good for the people. Now, this is my own personal opinion. I believe the EU will deploy some heavy-handedness to instill its own legitimacy, which will only make matters worse. The hyperinflation, which would soon come due to the inability of the ECB to react, the spiraling energy and food crisis will extend the people's woes and anti-EU stance. Eventually, their call will be heard and some governments will heed the people's call to leave the EU. So this is my personal opinion. And I think that there are indications that this could happen, especially with the recent shift in political acceptance of the right movement. So that's all I have for today, but let me talk about IFS. As Casey and I have often done, we actually start a membership for people to learn about about foreign share investment and how we identify trends and market situation. So at IFS, we study global economic, financial and commodity trends, government policies, and how they could impact specific industry. Now, from there, we perform case studies on companies which can potentially benefit from such trends. So here is a snippet of case studies that we have done. Okay, now in May 2021, we laid down the reasons why we think a uranium bull market is imminent. And since then, uranium has gone up 66.7%. Then in December 2021, we reiterated the case for nuclear power to gain traction in 2022 as shortage of oil and gas in Europe became prevalent. In the webinar, we featured Boss Energy, a uranium miner, and since then, Boss Energy has gained 20.8%, although it did reach a 52-week high of $3.10. When we did that case study, it was at $2.40. So we first featured uranium as far back as October 2016, when we featured energy fuels, chemical, and Summit Resources. Now, for some members who have joined us way back then, they'll probably will know. Okay, so even way back then, there has been some indication that the global uranium market could be heading towards a bullish trend. But at that time, the uranium stocks were all battered down. Okay, just look at a few here. When we first featured energy fuels in October 2016, it was trading at $1.41. Okay, at 14 September, energy fuels is trading at $7.14 for a gain of 406%. So sometimes, when you are investing in fundamentals, you need to adopt a very long-term view, okay, and not short-term trading and such. So anyway, energy fuels did reach a 52-week high of $11.39. Then when we first featured chemical in October 2016, it was trading at $10.62 Canadian dollars. And as at 14 September, chemical is trading at $39.19 for a 269% gain. It reached 52-week high of $41.39. So if we look at it at 270 over 6 years, it's still a very hefty double-digit gain, okay, if we average out on a per year basis. Then we also featured Summit Resources. At that time, it was trading at just 11.5 Aussie cents. And in 2018, Paladin Energy acquired Summit Resources, exchanging one Paladin Energy share for one Summit Resources share. As at 14 September, Paladin Energy is trading at 89.5 cents for 673% gain, although Paladin did reach a 52-week high of $1.12, which is almost a 10 times from that. So sometimes investment, you need, that's why I often mention that you need to have a better timeline and understanding of what lies ahead. And the uranium market has only just begun, because this is the only market that have a lot of investment banks as well as brokerages having a high rating on because of the energy crisis. And it is the only type of energy that can guarantee, nuclear energy is the only type of energy that can guarantee clean energy 24/7. But in solar and wind energy, you cannot have it because due to wind factor and also because of day and night factor. So we also issue WhatsApp alert, okay? Like 2021, we issue CGN mining alert when it was 47 cents. It did reach a high of $1.53 on 16 September 2021. And as at 14 September, it's still trading at $1.17 for a gain of 148.9%. Then, of course, as a member, you will receive our weekly report where I talk about the market, I talk about what happened, not mostly on what happened in the US and in the Hong Kong and China market, and then a bit more about other sectors that are showing some indication of investors' interest. And also I do write about geopolitics between the East and the West. So you can actually have quite a long read over the weekend. Okay, so our recruitment right now is open. You can go to www.investforeignshare.com, browse through the site where I posted some of our previous results and some of the trades that I have done myself. Okay, if you like to have more reading materials, which I write very frequently, you can go to my Facebook page at PC Wong Author. Okay, and you can follow and like, and then you can send email address to my email address here if you have any queries. So Q&A.
So yeah, PC.
Yeah.
Thanks for your update and your elaboration about the crisis. So let's do some quick Q&A because I know you got to go on like 12:30.
Yeah.
So let's answer briefly. So compared to US and Europe, which region will have more severe crisis relatively? Which one do you think? US
I
or Europe?
think in terms of banking, the EU is more severe because they are more highly leveraged. Okay.
Okay.
Next question.
Yep. You want to pick
Given future,
yeah.
Okay, Navang, you let me know. So
okay, given the near future market outlook is so dark, did you short the market? Do you do shorting?
I don't short the market, mainly because there are certain bear market rallies that can actually put a short squeeze. Okay, but I will look into those that actually have a long-term growth opportunity.
Then do you hedge your position if there's an anticipated market downturn?
I wouldn't hedge as well. I still believe in fundamental, and right now most of it is still in commodities, resources. And even though gold mining stock has done very badly, but they are in the cheapest valuation in history. So I still keep them. I still invest in uranium, copper, because these are the future energy stocks.
About the property market, so a developing country, a lot of the properties also drop, like happening in Malaysia and Singapore as well. So do you think is still going on for the next few years?
Two important things here. One is that the whole global economy revolves around two major giants. One is US, the other is China. So if either one of those sneezes, and China has already sneezed, okay, China economy is slowing down drastically. The Chinese government is not going to expand their economy like what they did after the financial crisis. They are in fact allocating resources to specific industry only. So property market in China will continue to be quite in the doldrums, and the US will go into the doldrums over the next few quarters. So I think that when both countries are down, the prospect doesn't look good everywhere around the world where certain assets with high interest rates are concerned. And this is actually the property market.
Okay, this is an economic question from Daniel. He said, all this debt to GDP higher than 100% by all these countries. So who are they actually indebted to?
Okay, most of the debt is being owned by the central banks themselves. Okay, like the ECB actually bought all the government's debt because no one wanted them. And the Federal Reserve is actually, during the last QE session, they bought back all the debt because they want to pump money in the world. I mean, to the US economy, not to the world. Okay, but I think that right now the Fed is not buying as much. They are actually tightening, which means that they are selling MBS or US Treasury or allow US Treasury to expire without reinvesting. So that will actually cause the yields to spike higher.
Okay, what's the impact of the hike of interest on the house rental market in the US?
I think the house rental market, surprisingly, even though home prices have fallen, the house price in terms of rental has not really shown the same fall in tandem. And that's why also because a lot of the rental properties are, like what happened during the last housing crisis, a lot of them were bought out by investors like BlackRock, a few other hedge funds and all those. So they are still renting it out at a high cost, at a high rent.
Okay, do you see Asian financial crisis 2.0 coming?
I think most Asian countries are very aware of that. And that is why, but this is another topic, maybe we can talk about next time. But that is why a lot of them are now uniting under the banner of the BRICS reserve currency. And you can see a lot of developing nations such as Saudi Arabia, Nigeria, Egypt, Argentina, all right now applying to be a member of the BRICS community. So the BRICS community would have a locally traded currency outside of the US dollar. So when that happens is that, they are, they actually envelop themselves in a interlocal currency swap so that they do not need to use the US dollar, okay, or the EU, the euro, so that they are a bit insulated. Otherwise, most of the emerging markets can see a very disastrous result as they borrow in US dollar and right now they have to finance at a much higher cost. So they are trying to insulate themselves in that.
Okay, Leon want to know your view on gold now, which are dropping like below 2006.
Actually, it is like I say, gold is dropping in terms of value in the US dollar is because of the strength of the DXY. But if you measure it in euro and in yen, okay, especially in the Turkish lira, gold has actually gone up quite steadily. So always look at gold as a wealth protection, not as an investment, because when everything, hits the fan, that is the gold and silver actually is something that can protect your wealth.
Okay, good. How to invest in foreign share with limited capital? When the capital is limited, should you like go overseas? I mean, to invest
I
overseas.
think the most important thing is that some people who are unfamiliar with foreign share investment, they will say, wow, like Malaysia 100 units and all those. Like Australia, UK, and US, you have singular unit, which means you can actually buy according to your own affordability.
Yep.
Of course, Hong Kong have different type of ranges. You have 10,000 or even 500 transaction per transaction. So actually, it's if you want to have exposure, you can expose yourself. Not expose yourself, sorry. You can expose your investment in Australia or US market.
In fact, it's well, a few thousand ringgit you can start with
Yes,
already.
yes, yes,
You
yes.
don't need to have a whole lot of money. So more question from GS. Okay, I'm gonna read this out. With potential debt, housing, financial crisis in many countries, with the US rate hike, the US has to pivot some point, even in this inflationary environment. So when will the
Yes.
US pivot?
I think it will come a point in time when the government will force the Fed to, because right now we are seeing a lot of layoff in the tech sector. And I think the coming layoff would be in the housing sector and the fall in the a potential housing crisis. Okay, because then the Fed will know that if they continue with this any longer, the entire economy will collapse. And also, Jeff Gundlach, very also known as the new debt king in US, he is already saying that the Fed shouldn't hike 100 basis points because they already hiked so much during the last few months. They should just sit back and watch how it play out in the economy rather than keep on hiking and then everything falls off the cliff, which I think the Fed will do that, because just like they have zero range-bound interest rate for so long, right now we are seeing this kind of inflation because the price is always a lagging factor. So I think over the next few months, we will see the housing crisis deepen, home prices will fall, and then the Fed will be forced to react.
Okay, PC, can you put the slides that's before this so that people can contact you and go to the site as well?
Okay.
Yep. More questions, just a little bit. We still have a few minutes to go. Kenny want to know, with so much withdrawal of silver and gold from the vault, is it safe to stay with ETF silver or gold?
Okay, I think that now very importantly when it comes to silver and gold ETF, do not go for the GLD and the SLV, because ever since the silver squeeze in the February of 2021, both the ETF have come out with a prospectus, amended their prospectus, which say that there is no way they can guarantee the physical backing of the metals against the ETF. So if you want to have a trust, okay, because the SLV and GLD also allow derivatives, but the one that is pretty much safer would be the PSLV, which is the Spot Physical Silver Trust, as well as the PHLV, I think, which is the Spot Physical Gold Trust. So this one is 100% backed by physical gold and silver. So that would be much better if you want to have exposure to the price movement of gold and silver without needing to pay for walk charges and so forth. Okay, but GLD and SLV not so, because it is owned by the banks that are manipulating the price of gold and silver to suit their own needs.
Nasruddin want to know what are the undervalued uranium stock in the US. Like, would you be able to give a few names?
I think right now most of the uranium stocks have already been discounted from their November, December high. So you can literally go through every one of them, okay? But like I say, most of the most popular one with the greatest weightage is weightage by investment banks are actually chemical. Although there are certain explorers, okay, that have now been looking at some very good and high-grade uranium, such as Denison, as well as Fission Energy. These are a few that I can name. There are a lot more, but I'm mostly invested in, yeah.
I mean, actually, you did a thorough research on some of the names you mentioned in the members area.
Yeah.
So if you join today, you have immediate access to that if you want to know. Okay. Last two questions. Okay, how about where to buy your book, right? You have two books on foreign investment. One is REITs and one is Invest Foreign Share. But some times ago, can we still find it in a popular shop?
I already discontinued because when they want to order, I told them I do not want to, because normally you have to print in advance. So, but if you join our members area, you can have direct access to the books.
The digital version, digital version. Yeah, you have the full digital version.
And also my third book as well, which is Global Economic Collapse, which I published in 2020. You can get access to it in the members area.
Okay, Johnson, he said buying call option with long expiry date of more than 2 years in US, good tech stock like Google, Amazon, and SML. Do you think that is workable?
I am not an expert in call options and all those, so I do not want to dwell too long about it. Okay, but I'm mainly one person who focus on fundamentals.
Yep. Okay. So Pusparani is wondering since there's inflation, so higher construction costs, isn't that Malaysia's property will actually go up in prices rather than crashing down?
But then it is measured against the rising interest rate. Now, Malaysia inflation rate is 3.1%, but our new interest rate is just 2.75%. Now, when inflation rate far exceeds the interest rate, you are going to see deterioration of the currency value.
Okay, so one last question before I let you go, right? China banks price to book ratio is very low. So with the housing debt issue in China recently, same thing you mentioned for Europe will happen to China too. Do you think?
I think the China banks are actually have certain amount of risk, and that's why I totally not investing in any banks at the moment. Okay, because if you want to look at the banks in the number of assets, in the amount of assets value, yeah, at least a few Chinese banks are actually in the top 10. So that means they are carry extremely high asset value, and that is a risk because when you have more assets, when the assets devalue, then there's more risk. So to a certain extent, they will have certain exposure, but most of the Chinese banks that are also in the top 10, they are actually SOEs, okay, which means that the government will be more ready to bail them out. But I guess even in the Europe and the US, they will still bail them out, rather than let them fail.
So yeah, thank you very much for everybody for attending. So PC is having a staycation in Ipoh, so we have to check out hotel right now. So we cannot keep him any longer. Wish you a good food hunt in Ipoh, PC. And for everybody,
Yeah.
if you want to join to hear more from PC for the updates, he updates our members every week. You can join our program at investforeignshare.com. Hope to see you all there. Thank you, PC.
Yeah.
Thanks
Thank
everyone for
you.
attending. Bye bye.
Thank you. Bye bye.